So you pack your bags, say goodbye to Costco, Wendy's, this guy, and move abroad. Congrats. But guess who's still coming with you? The IRS. Yep, Uncle Sam doesn't care if you're sipping espresso in Rome or lounging on a beach in Bali. He still wants his cut.
We are Diana Guillermo. As Americans living abroad, we've spent the last 6 years navigating the U.S. tax maze and figuring out how to stay on the right side of the law without losing our sanity or giving up too much of our hard-earned retirement money. We spent our first 3 years in Mexico and the last 3 years in Portugal. We know a thing or two about paying taxes. While we're not tax professionals, we're here to share what we've learned so you can avoid common mistakes and maybe even save some money.
In this video, we're breaking down everything you need to consider about paying U.S. taxes while living abroad, what to plan before you leave the U.S., and what to stay on top of after you've settled into your new home overseas. Get your pen and paper, and let's get started.
All right, you've made one of the biggest decisions of your life. You're leaving the U.S. and moving abroad. But here's the thing, being an American means your tax obligations don't stay behind. You'll still have to file U.S. taxes every year, and depending on where you move, you might also owe taxes on the same income in your new country. Yep, living abroad comes with incredible perks, but navigating taxes, that's a whole new adventure. There are a few important things to understand that can make a big difference when paying taxes.
Check if your new country has a tax treaty with the U.S. Why? Because a tax treaty can save you from paying taxes twice on the same income. Some treaties even exempt things like U.S. Social Security or government pensions from local taxes. Luckily, Portugal, where we are currently home-based, has a treaty with the USA. This allows us to utilize the foreign tax credit and avoid paying taxes again on the same income. Do a little digging, find out if a tax treaty exists, and, more importantly, how it applies to you. Because the only thing worse than taxes is paying them twice.
Retirement accounts get tricky when moving abroad, especially Roth IRAs. In the U.S., Roth withdrawals are tax-free, but many countries don't see it that way. Some, like Portugal and Spain, tax them as regular income, while others, like the UK and Canada, recognize their tax-free status. In the U.S., qualified Roth IRA withdrawals after age 59 and a half are tax-free because you paid taxes on contributions up front.
Portugal, for instance, doesn't mirror this. Under the U.S.-Portugal tax treaty, private pension income, like IRA and 401k distributions, is taxable only in your country of residence. In our case, Portugal, since we are tax residents living here more than 183 days a year. If your long-term financial plan includes Roth conversions, keep in mind your new country of residence may treat these conversions as taxable income also. Retirement accounts, especially Roth IRAs, need to be handled carefully when living abroad, so it's important to plan ahead.
It's important to determine whether your U.S. government pension, retirement accounts, or Social Security will be taxed also. The good news? If you worked in public service, whether in the military, federal, state, or local government, you may be in luck. Many tax treaties exempt U.S. government pensions and retirement accounts like 403b plans and thrift savings plans from local taxation, meaning they're only taxed in the U.S. Social Security, on the other hand, depends on your new country's tax treaty. Some countries allow the U.S. to tax it exclusively, while others claim the right to tax it locally. It's important to check the details of your country's tax treaty to avoid surprises. Like many Americans, we want to protect our money and minimize paying taxes living overseas. These are two U.S. tax tools that can help you manage your tax obligations and save you money: the Foreign Earned Income Exclusion, or FEIE, and the Foreign Tax Credit, the FTC. The FEIE allows U.S. citizens to currently exclude a portion of up to $126,500 of foreign earned income, like salaries or freelance work, from U.S. taxes. You must qualify by meeting either the bona fide residence test or the physical presence test, though. And here's the catch. It doesn't cover investment income, rental income, or other passive income streams, so those still get taxed.
For a simple example, you earn 15 million yen working in Japan, or approximately $100,000. With FEIE, you exclude the $100,000 from U.S. taxes, so you only pay Japanese taxes on the amount.
The FTC lets you offset U.S. taxes with what you've already paid to your new country to avoid getting taxed twice. It only applies to income that's taxed by both countries. In the case of taxes on Roth IRAs, you would not be able to obtain a credit on your U.S. taxes for taxes paid to your new country, since the USA does not tax Roth IRAs. Now, if Portugal taxes your salary, but the U.S. does too, you can offset the U.S. tax bill with what you already paid Portugal. The credit also applies to investment income, rental income, or other passive income streams.
For example, if you receive $50,000 in passive income, like rental or investment income, from the U.S., you may pay up to $14,000 in Portuguese tax, and you may owe $2,000 in U.S. tax, since both countries tax you worldwide income. With the FTC, you credit the $14,000 paid to Portugal against the $2,000 U.S. tax, wiping it out completely. So you owe the U.S. $0.
In short, the FTC shines when you're paying high foreign taxes, dealing with passive income, or earning above the FEIE cap. You can't double dip, though. If you use the foreign earned income exclusion to exclude income on your U.S. taxes, you cannot also claim the foreign tax credit on that earned income. Here's an important warning. Once you choose the foreign earned income exclusion for a tax year, it can be difficult to switch back to using the foreign tax credit for a few years. So make sure you fully understand your tax situation before making this decision. It's not a simple flip-flop. You're committed to your choice for the next couple of years. Just remember that tax systems don't always match up perfectly, and not all taxes qualify for a credit. Careful planning is key. Knowing when to use the FEIE, when to claim the credit, and how your host country taxes income can make a big difference. A little strategy now can save you a lot of headaches and money later. Before making any decisions, be sure to talk to a tax pro.
We recommend Taxes for Expats. They assist anyone with U.S. tax obligations, whether individuals or businesses, and help them achieve peace of mind with their taxes. They even offer tax planning consultations with an expert.
Need tax help? Just scan the QR code on the screen or click the link in the description to get in touch. For those Americans moving from high-tax states, there may be ongoing state tax filing obligations. Some states, including California and our home state of Virginia, have stringent rules and may claim tax residency for several years after a citizen's departure. In our case, we are unable to cut ties with Virginia because of our rental properties and bank accounts there. If you know you'll be gone permanently, it's best to establish residency in a no-income tax state like Florida, Texas, Nevada, or South Dakota before moving abroad.
Grand Alive Retirement Travel is a couple that we watch on YouTube. They have a nice video where they explain how they established residency in South Dakota as full-time travelers. They share a ton of good info. We'll leave the link to their video in the description.
Know and understand how your new country's tax system works. Will you be a tax resident right away, or does it take time? Some countries tax your worldwide income, while others only tax what you earn locally. In Portugal, Tax filing starts right away if you become a tax resident, but your obligations depend on when you establish residency. If you move mid-year and meet the 183-day rule or set up a permanent home, you only owe taxes from the date you become a resident, not for the entire calendar year.
We listed a good source where you can find information on the different tax systems around the world in the video description. This will give you a solid starting point. Make sure you understand when you need to file and what income is taxable so there are no surprises. Just because you live abroad doesn't mean you escape U.S. estate and gift tax laws. They still apply no matter where you are. On top of that, some countries impose their own inheritance or wealth taxes, which could affect what you leave behind for your loved ones. To avoid surprises and unnecessary tax burdens, it's smart to review estate planning strategies before moving. We use Bolden to plan different scenarios and develop a estate plan. We are gifting our son Devin more money each year as he reaches the stage in his life when he may need help with the house down payment, building a business, or starting a family. It's important to us to make sure taxes are covered, not only to optimize our burden, but to minimize his in the future. A little planning now can save your heirs from major headaches later.
Once set to leave the good old United States of America, many Americans want to take their money out of U.S. investment accounts and invest overseas. Fair enough if you're afraid of the U.S. markets or want to diversify outside the U.S. dollar. Some people invest in PFICs, or passive foreign investment companies. Think of it like a foreign mutual fund or investment company that mostly makes money from your investments rather than running a regular business. These include foreign mutual funds, ETFs, and even some pension plans, and they come with nightmare-level U.S. tax reporting. Hello, Form 8621. And don't forget hefty taxes. The IRS is not kind to PFICs, so to avoid the hassle and high interest charges, it's usually best to stick with U.S.-based investments.
Timing matters when filing taxes abroad. In many cases, it's best to file your foreign tax return first. They use that info for your U.S. tax return to claim credits for taxes already paid.
We personally file our Portuguese taxes first, then extend our U.S. deadline to ensure we can deduct what we paid to Portugal. This avoids double taxation and makes the process smoother.
The U.S. tax deadline is April 15, but expats abroad get an automatic extension to June 15. And if needed, you can request an extension until October 15.
Set reminders for tax deadlines in both countries so nothing slips through the cracks. If you have foreign bank accounts, you might need to file an FBAR, a foreign bank account report. The rule is simple but strict. If the total balance across all your foreign accounts ever exceeds $10,000 at any point in the year, even for just one day, you must report it. The U.S. government uses the FBAR to track money held overseas and prevent tax evasion. Even if you're living abroad legally, you are still required to report your foreign financial accounts. This includes checking, savings, investment accounts, and even digital wallets like Wise or PayPal if they're held abroad. The deadline is April 15th, but there's an automatic extension to October 15th. Missing it can lead to hefty fines, so keep an eye on your balances and set reminders. Ignoring it might cost you way more than you expect. Or you can simply file one every year like we do to avoid any questions. On top of the FBAR, you might also need to file a FATCA if your foreign financial assets exceed $200,000 as a single filer or $400,000 for couples living abroad. While FATCA and FBAR often overlap, they serve different purposes. FBAR reports foreign bank accounts, while FATCA covers a broader range of financial assets, including foreign stocks, mutual funds, and pensions. Keeping track of your foreign accounts is crucial, and if you're unsure whether you need to file, a tax professional like Taxes for Expats can help you avoid costly mistakes.
If you plan to be self-employed while living abroad, you may still owe U.S. self-employment taxes, which means paying Social Security and Medicare just like you would in the United States. However, if your new country has a totalization agreement with the U.S., you may be exempt from U.S. self-employment tax and instead contribute to the local Social Security system.
In our case, since income from making videos on YouTube is considered self-employment, and Portugal has a totalization agreement with the U.S., we contribute to the local Social Security system. The key takeaway? Know where your tax obligations lie to avoid double payments and unexpected surprises.
Let's say you're settled in your new country. You find an opportunity to buy a real estate investment property and rent it out for extra income. But guess what? If you earn rental income from a property abroad, you must report it on your U.S. 1040 tax return Schedule E, just like a U.S. rental property, even if you're already paying taxes on it locally. Also, you must report all income received in U.S. dollars, therefore you must convert the foreign currency.
The good news? You may be able to deduct expenses like maintenance, property management fees, and even depreciation to reduce your taxable income. To stay compliant and avoid issues, keep detailed records of all rental income and expenses. It'll make tax time much smoother.
If you own or trade cryptocurrency while living abroad, yep, you're still required to report it to the IRS. The U.S. treats crypto as property, meaning capital gains taxes apply when you sell, trade, or use it for purchases. Even if you store your crypto in a foreign exchange or wallet, it doesn't exempt you from U.S. tax obligations.
Want to know more about foreign taxes? We made a video about Spanish taxes for expats, where we cover everything you need to know about the tax system for foreigners in Spain, including inheritance and wealth taxes that you may find helpful. We will be working on Portuguese taxes for expats in the near future in case you're thinking of moving to Portugal. Let us know in the comments if you have specific questions about Portuguese taxes, and we'll cover it in the video.
All right, that's a wrap on navigating U.S. taxes while living abroad. It might seem overwhelming, but with the right planning, you can avoid costly mistakes, minimize double taxation, and keep more of your hard-earned money. Understanding your tax obligations is key. And remember, we're not tax professionals, just expats sharing what we've learned along the way. If this video helped, hit that like button, subscribe for more expat insights, and let us know in the comments what tax questions you have. Thanks for watching, safe travels, and smart tax filing.
See you in the next one.